Hi, everyone, and thank you for joining today. My name is Jason Russell, and I'm a managing director with the investment banking team at Morgan Stanley, and it's my pleasure to be with you today. For today's webinar, I'll be covering some considerations for biotech startups, primarily geared towards fundraising. Before we jump in, I'd just like to thank the MassBio team for the opportunity to present to you today. Over the past few years, MassBio and Morgan Stanley have formed a very strong partnership, and we're proud to support MassBio's mission to advance Massachusetts leadership in the life sciences, to grow the industry, to add value to the healthcare system, and to improve patient lives. Turning to slide 2, perhaps just a quick background on my and Morgan Stanley's role in the biotech ecosystem. As a biotech investment banker, my entire career has been dedicated to working with biotech innovators. I've had the privilege of working with leading innovators across the ecosystem and partnering with companies to achieve their financing and strategic objectives. Some of those representative clients are shown here on this page. As a global investment bank, Morgan Stanley's role in its simplest form, both from the investment banking business as well as the broader institution, is simply to facilitate access to capital from groups that have it to the groups that need it. This happens through traditional fundraising efforts such as equity and debt capital raising, but also through mergers and acquisitions as innovator companies pass the baton, proverbially speaking, from one company and one part of the life cycle to another. Clearly, within the life sciences ecosystem, capital is the lifeblood to progress. Developing breakthrough science and funding preclinical and clinical development is incredibly expensive, as we all know. Our job at Morgan Stanley is to play a small role in that capital allocation process by ensuring that high quality, potentially impactful projects and medicines get funded and have the opportunity to get to patients. It's an incredibly rewarding role for me to work alongside entrepreneurs and play just a small part in that process. So now turning to slide 3 and the topics for today's agenda. First, I'll cover just some basics of biotech fundraising. These are geared to be high level, and I suspect most of all of this will be familiar to you already. But hopefully this will be a helpful and quick refresher on some of the key concepts related to financing for biotech companies. Next, I'll provide an update on the current biotech financing environment for public companies. The public markets are a fairly good indicator of the health of the entire fundraising ecosystem, and clearly it's very common for biotechs to seek a public listing to facilitate their development and growth needs. And then as the third agenda item, I'll discuss a few key considerations that may be relevant for an entrepreneur. There will be a Q&A session at the end, and I'll be happy to take any questions through the Q&A functionality. I'm also happy to connect one-on-one with anyone following the webinar. So now let's jump in. I'll flip to slide 5. So this slide is here strictly to provide a reference of some of the key terms used in the fundraising ecosystem. I think it's important to understand as you consider building a financing plan, and also to reference as part of the lingo when I'm covering the market update in a few slides. So maybe briefly going through these. First on the list is equity value. This is simply the total value of the company to shareholders, calculated simply as total shares outstanding times the most recent reference price. For private companies, the price might be the valuation at the latest round. For a public company, obviously this would be the latest share price from an exchange. There are a few nuances to the calculation of equity value. I won't try to cover those here, but they will be important for you to understand if this topic becomes relevant for you down the road. Next on the page is pre-money equity value. So this is effectively the valuation immediately prior to a financing round. This is the value where new shareholders are buying into the company and effectively setting a price. Next, post-money equity value. This is simply the pre-money equity value, but adding in the additional shares as multiplied times the price that are issued for that financing round. This then represents the company's new equity value at the moment in time when the round is completed. Next, I'll spend just a few seconds here on step up. So a step up, quote unquote, is the simplest, is simply a ratio showing the increase or decrease in value from the prior round. It's calculated as pre-money equity value of the new financing round divided by post-money equity value of the prior financing round. To give an example, a company has a Series A post-money valuation of $50 million. That company is raising a Series B round at a pre-money equity valuation of, let's say, $85 million. The quote step up for the round is 1.7 times, effectively illustrating that the absolute value increase from the prior round to the current round. I highlight step-ups because they are thrown around in kind of in biotech and venture capital financing in general quite frequently. But one thing to note and to remember is that a step-up is simply an output. It's not a primary valuation metric and should only be considered a reference with regards to valuation from one point in time to another. The ultimate actual valuation, whether it be a private round or a public round, should be determined by the progress and the merits of the company. Clearly, the state of the private and public markets will have an impact, and as well as the macro environment. And ultimately, any financing round comes down simply to supply and demand. More demand, likely ability to push price higher. So moving along on the page, and I'll try to move a little bit faster. I suspect this group is fully aware of an IPO and what that means. I think the one thing I would note is that initial public offering is not an exit in our sector typically. They typically have it years in advance to actually having an approved product, and the company still has massive capital needs. This typically means that an IPO for a biotech is strictly a financing event, getting the company the proceeds from the IPO and enabling future access to the capital markets. There are limited exceptions for an IPO where modest liquidity for some pre-IPO shareholders may be needed or required. I would say that those circumstances are very rare. And then lastly on this page, I called out and noted the SPAC, or the Special Purpose Acquisition Company. SPACs have been around for a long time, frankly, but only recently did they become part of the more mainstream discussion with regards to biotech and the life sciences industry. That's a result and being caused by more healthcare specialists, investors actually standing up a SPAC, such that they're designed to specifically invest in biotech. A SPAC is an alternative to an IPO and comes with certain benefits, but also many considerations. Given our limited time, I won't cover this in more detail, but happy to follow up as helpful. Okay, so turning to slide 6, I'll quickly discuss the key participants across the biotech fundraising ecosystem. the issuer is simply the company that's issuing shares to raise capital. I think that's fairly clear. Seed investors are often those investors that invest early on in a company's life cycle, typically even at the formation stage of a company. These type of investors can include venture capital, certainly, but often may also include friends and family, so-called angel investors, or even large corporates, i.e. maybe a large cap pharma. Next on the list, venture investors. So VCs are obviously critical to our ecosystem. They typically have deeper access to capital and really can start to fund projects and push projects forward aggressively. There's certainly various flavors of VCs, but in biotech, these investors are frequently focused on company formation, with some examples noted here on the page. Lastly, on the list would be crossover investors. This term encompasses a very broad swath of investors that typically may be interested in investing prior to an IPO, but are also typically seeking a public listing in the relative near term so that they can meet their fund liquidity requirements. Examples may include growth-oriented venture, again, some of the venture investors that I already referenced, as well as others. Long-only mutual funds, such as a Fidelity or a T. Rowe, specialist healthcare hedge funds, the likes of a few names would be RA Capital, RTW, or Perceptive, or even potentially sovereign wealth funds, such as Temasek or ADIA or the Abu Dhabi Investment Authority, and lastly, pension funds. So you can see that at the crossover, quote unquote, stage of investment, typically, right before an initial public offering, the access to capital really broadens and the pool of potential participants is really broadened. And so next, maybe I'll turn to slide 7 and perhaps just talk about a hypothetical financing timeline for a startup biotech. So this is very high level and clearly illustrative. Every financing strategy for every company is different, and every company's financing needs are different. But in my hypothetical scenario here, the company is shown on number 1 executing a seed financing, typically perhaps in the single million digits or of proceeds, and these proceeds are really focused to stand up the company. Perhaps focus on gathering IP from an academic institution or testing a killer experiment to really prove out the thesis of the opportunity. And as a company knocks down a few of those milestones, they might quickly progress to more expansive private financings. And these would typically be rounds, these Series A and Series B, kind of illustrated in the middle of the page, done with institutional investors. The rationale for institutional investors is that, frankly, they have deeper pockets and they can help fund progress and fund a more expansive portfolio than perhaps an early stage seed investor could invest. And then, as I noted on the prior page, and just tie it back a little bit, a company might progress, to begin thinking about an IPO, and the life cycle of the ecosystem of biotech has evolved in such a way that crossover investing is frankly often a precursor to an IPO. A crossover investment effectively serves 2 purposes. One, it certainly delivers additional financing to the company, so really shores up the balance sheet. But 2, and probably, frankly, more important, is that it offers a de-risking mechanism for the IPO. See, these crossover investors will frequently look to grow their position in ownership in the company at IPO. And therefore, by investing pre-IPO, it allows them to have a foothold into the cap table, and allows them to get the size of position that they would like. And the benefit to the company is that it ultimately shrinks the amount of demand necessary to successfully consummate an IPO. So the other benefit of a crossover investor syndicate is that it really does bring home and allow for significant validation of the company, its programs, and most of these investors conduct significant due diligence, which just helps to further validate the opportunity as a company might look to go towards an initial public offering. Lastly, shown on the right side of this page will be the IPO. I would just reiterate that an IPO, while an awesome experience and obviously a momentous occasion for a startup, is really still just the early innings. It's important to know it's a financing event, but it is it takes many months of, and frankly sometimes years of preparation and setup to prepare for that event. And as a potential entrepreneur or would-be public CEO, running a public company is a different experience. Certainly comes with obligations and distractions, which might not be welcome with regards to taking you away from focusing on the science. You also have the luxury of suddenly having public shareholders, which are known to share their views with you at all times. So now I'd like to shift with that overview of the financing lexicon. I'd like to shift to a quick overview of the biotech markets themselves. And on these slides, I'm specifically focused on the public market. That's clearly in my role at Morgan Stanley, where I spend more of my time. But as an early stage or emerging company, the health of the public markets is going to be a good indicator of the health of the private market. So I hope this content's valuable. Slide 9 is really here to provide a snapshot of performance across the entire landscape. As you'll note on the left side of the page, performance for biotech has been robust. It would frankly even look more robust, as you'll see in a few slides, if I had included data prior to 2020. But if you just focus on the light blue line, which represents the XBI being an index fund that we broadly believe tracks the broad performance of biotech, you can see a 38% return since the start of 2020, clearly outperforming the S&P 500, and that's despite the recent volatility that we've seen in the prior few months. On the right side of the page, we looked at performance a little bit differently, and start to see a little bit of a different picture, actually. Maybe starting in the bottom right, the 2021 performance. So here, clearly 2020 was the year for biotech. The XBI up nearly 50%, with the S&P still a very respectable 16%. But that just goes to show you how investment and interest in the sector, and frankly, the sector, generating on important milestones for investors, has really driven robust outperformance over that period. But if you shift to the top right quadrant and look at the 2021 to date performance, you start to see a slightly different picture. Actually, the XBI is down this year, and as comparison to a broader market with the S&P still, reaching new highs and up 11% on the year. I think we'll cover some of the reasons why that might be in a few pages, but I think important to show you how things are starting to diverge just a little bit. I'll now flip to slide 10. So here, and as I noted, perhaps one of the reasons for the pullback in biotech relative to the other sectors just frankly relates to the broad outperformance over such a long period of time and the level of issuance for the past handful of years. So what you'll see here on this page, and if you focus on the yellow line, the XBI is up a whopping 350% since 2013, which is phenomenal. And what's also incredibly interesting is the uptick in financing activity. So 2020, if you look at the bar near the right side of the page, it was double the activity in 2019, which was already robust. And if we look at 2021 to date, we're actually tracking on the current run rate to potentially outperform 2020. These are astonishing numbers and obviously incredibly supportive of all the activity in the industry. So turning to slide 11, this slide provides a bit more granularity. I'm not going to try and cover the detail here, but hopefully a helpful reference point. Perhaps just a few quick things to call out. First of all, if you look at the graph in the middle, top middle, you'll see that valuations, so pre-money valuations, as discussed earlier, have grown significantly across the sector. So now for the past 2 years, median pre-money value of greater than 500 million, which is pretty incredible. Moving to the top right figure, you can see pricing outcomes, as shown with the color coding, have actually become more predictable. And what this effectively tells us is how an IPO priced in relation to the range that was set on the day that the IPO launched. And one of the interesting things to consider here is that some of this predictability, having tongue-tied today, is related to the crossover dynamic, which I discussed earlier. A recent round with very high quality institutional investors who have a strong perspective and basis to understand valuation means that the market has just become more efficient in that regard. Moving to the bottom right, perhaps as the last point, the bottom left actually, next to last point to cover. This just shows you the relative step-up metrics. Again, the point I discussed earlier about a round-to-round comparison on absolute valuation. Just keep in mind that step-ups don't account for time. And so some step-ups might have a period of 3 months between financing rounds, and some might have a period of 3 years, which clearly is a different proposition. And then maybe just on the last figure to discuss here is the bottom right quadrant, or bottom right figure. So this figure shows performance from IPO investors over a period of years. And what you can see here on the bottom right is that performance over 2020 and 2021 has been robust, which does feed on itself within the ecosystem. Effectively, investors in the public markets investing in IPOs for biotech companies have made money. And as a result of that, that's encouraged them to continue to invest in the industry. Although, as I'll show you in another page, certainly the aftermarket returns have softened a bit, and it does feel as if our current market is going to start to become a bit more muted in the type of outcomes that we have been seeing in 2019 and 2020. So moving to slide 12, this exhibit might look familiar. It was actually on the prior page, but I just wanted to call it out, at least the left side, so that you could see it in a bit more clarity. So the left side of this exhibit again, just showing pre-money valuations, and you can just see the exponential growth compared to how things used to be in the earlier years. And on the 2021 class to date, we're already trending towards a median of 530 million. And also, interestingly, is the right side of the page, which is the average IPO deal size. In the 2014 to 2019 period, average deal size were plus or minus $100 million, depending on the year. Today, the average IPO deal size for a biotech is greater than $200 million, which is great for companies and for development, but does call into question of sustainability. Slide 13, I will not cover in detail. This is obviously quite an eye chart, but here for your reference. This is just a summary of the last 30 biotech IPOs. The column I'd call your attention to, if any, would be the fifth column from the right, which is denoted pricing outcome. So this column indicates where a deal priced in comparison to the initial valuation range at launch. And the nuance here is that you can really pick up by just following the color coding is starting at the bottom of the page. These are offerings that were kind of the end of 2020 and the beginning of 2021. You see a lot of green. These are pricings that happen at the top of the range or above the range, phenomenal outcomes. And then as you start to get to the top of the page, which are the more recent data points, you start to see some more mixed results. Pricing in the midpoint of the range, pricing at the low end. We also start to see some deterioration in aftermarket performance. And I think this all just helps to inform us of the type of market we're in today, which is one that probably requires a bit more caution, a bit more thought around valuation, and is probably going to be a bit more selective. Moving to slide 14, I'll go over this quickly. This is again a reference to the step-up data that I noted. Some pretty eye-popping numbers on this page. 2021, step-ups have been quite spicy in that we're at 1.6 times, often on the back of a crossover that may have closed months or weeks before the IPO. I would note though that this market is clearly as of today being much more disciplined, and I do expect some reversion back to a bit of normalcy in the coming months, perhaps more like the type of step-ups in 2018 and 2019. Moving to slide 15, I think this is just an incredibly interesting analysis. So on the left side of the page, you can see IPOs broken out by year, but then broken down into general therapeutic category. You can note the prominence of the dark blue and the light blue, particularly the dark blue though in oncology, and that since 2017, well over 30% of all IPOs have been oncology focused. This is somewhat a function of where the science has made progress, but to be fair, also where frequently where investors see the most opportunity for returns, based ultimately on patient need and also what large cap pharma is ultimately looking for. Excuse me. As an opposite example, you don't see a breakdown of antibiotics on this page, which is frankly unfortunate. There have been some antibiotic IPOs over this time frame, but the appetite for those types of stories has weakened as the current dynamics of a complex reimbursement system and hospital incentives or disincentives to use branded new drugs for infections has made it challenging for antibiotics to get used and therefore challenging to reward innovators for their progress. And while I'm sure everyone watching this today would agree that having novel antibiotics is a critical need for medicine, perhaps more critical than finding the next oncology medicine. Something major will have to change with regard to policy in order to make it a more attractive investment area. I certainly hope it does. Moving to the right side of the page, another incredibly interesting exhibit. So here we've broken down IPOs based on their stage of development. And in the clear trend, just looking at the dark blue and the medium blue, is that IPOs have gotten earlier. In 2020, preclinical and phase 1 IPOs represented greater than 65% of all biotech IPO issuers, and is trending even higher in 2021. And so a few thoughts on this. While it's clearly great that companies are getting access to capital, they're getting into the capital markets earlier, perhaps to fund their development. The word of caution, perhaps, to entrepreneurs would be think carefully about it before you follow the same path. You only get one chance to do an IPO, and once you're public, you're public. And as a public company, you will be judged based on the milestones and the clinical progress that you deliver. So unfortunately, many a company have gone public early, only to find themselves having had a setback in their portfolio, relatively soon after IPO. And as a result, it creates a bit of this do loop where companies and executives find themselves with a depressed stock price and challenges raising additional capital, all while trying to obviously address the setback. It is worth thinking carefully, because you will get judged in the capital markets by investors based on what you deliver. And I think the other point here is also, don't forget about your other stakeholders, or one of your other stakeholders, your employees, many of which are compensated in part by company stock. We all know that the environment is incredibly competitive for talent, and certainly a setback and a depressed stock price could be fairly demotivating for new employees, and in a world where opportunities are fairly robust. Moving to slide 16, and perhaps a really good recap for this overview is this exhibit, which really summarizes some of the thoughts and frankly the robust transformation of the biotech ecosystem. The progress of science is clearly the driver here, and has enabled an explosion of activity, which, as you can see, has grown the landscape in an incredible way. So to call a few points out, just in the blue category at the top of the page, in 2008, there were 44 publicly listed companies in biotech with a market capitalization between 500 million and 2.5 billion. Today, that number is greater than 200, which is just truly phenomenal. And most importantly, I think incredible in that it's an indicator of the progress that you are making in finding and working hard to find novel medicines to deliver cures for patients. So thank you. So now I'd like to transition to the last topic, and slide 17, which is just a few thoughts around some key considerations and advice that I thought might be helpful for would-be entrepreneurs. I certainly can't profess to be an entrepreneur, I'm an investment banker working at a multinational investment bank. That's probably the opposite of an entrepreneur in most respects. And I don't have the scientific background that many of you do. But sitting on my side of the ecosystem, these are just some observations which I think might be valuable from a fundraising and business perspective. So first would be leverage your network. And as you're thinking about a company, an exercise to potentially start a company or extract an asset out of academia and how you might finance that. The good news is that many people have done it before. I showed you on the prior slide how robust the public markets have been, and how much the ecosystem has grown over such a short period of time. And what that means is that there are many executives, many companies, many mentors who have done it. And so that network of people is critical to help you vet a business plan, vet a fundraising plan, and get perspectives before you take the plunge. Number two is make sure that your business plan and your budget and pipeline are all designed to drive progress. We all know that developing drugs costs a tremendous amount of money, and unfortunately, or perhaps just because of capitalism, progress with one's portfolio and access to capital are interlinked and frankly circular. And so when standing up a financing plan and how to think about funding your company or your projects, one needs to focus on the milestones, the experiments that deliver de-risking or deliver value. Because in order to keep every additional layer of investors and capital that you bring into the company, clearly you need to keep those groups engaged and happy with the progress and obviously success in the portfolio and knocking down barriers for any product or product candidate is critical to do that. To be clear, this is biotech and it's risky. There will be setbacks, and that's the trial and error nature of the industry. So while clearly everyone knows, failure will happen and it will happen, you have to do the best you can at the onset to set yourself up for success and give yourself an opportunity with a business plan to deliver that killer experiment or deliver that data that will engage that next level of interested investor, which you're going to need as you grow the company and become a much larger entity. Third point here is to be very thoughtful about your investor syndicate. So all investors are not created equal, and used to be all money's green, but maybe in the age of Bitcoin, maybe that's not true either. But all investors are not created equal either. And so I think you need to ask very thoughtful questions to yourself, to your network, to the investors about their style and frankly what fits what you're trying to accomplish. So as an example, do you want a hands-on investor who guides you with their wealth of experience in startups and provides valuable insights on preclinical or clinical trial design? That's great. There's a lot of wonderful venture capital groups and other types of investors that have that experience. But that comes with the perspective that they likely might try to extract value for that experience and those services, and also control of what you might be trying to build. So certainly need to keep that in mind as you formulate your syndicate. Maybe the fourth point, and quickly just to touch on partnerships. Frequently, partnerships are a great tool for quote non-dilutive capital to a company, particularly early stage platform companies, to advance a program or a concept. And many companies have used partnerships with great success. But remember, partnerships do come with significant obligations and distractions. You have to execute on the agreed upon plan. You have to use the capital that might be injected in the way that the partnership dictates. And despite the fact that you're not selling equity outright in a partnership structure, perhaps, you're still giving up certain rights to either a program or a platform that one day could have proven to be incredibly valuable. So while partnerships are a necessity and often a great tool for an early stage startup to get off the ground and minimize dilution at the onset, just carefully evaluate the pros and cons and also the distractions that multiple partnerships might create for your organization. And then the last point, and then I'll close, is a point that I touched on earlier, but I think is worth repeating. I obviously love IPOs. I'm in the business of, part of my business and part of the investment banking industry is taking companies public, and it's a process, an event that we all really enjoy doing. It's frankly incredibly rewarding to do it and to be, frankly, a small part of the work that you're doing. And it's worth celebrating. But the ultimate goal is obviously not a splashy IPO. The ultimate goal is deliver on your promise, deliver on bringing novel therapeutics to patients. So I just encourage you to think about an IPO as an event. It's a financing event. It's a gateway to future access to capital. But also just keep in mind that going public does come with significant obligations and unfortunately in many cases often takes a founder or entrepreneur away from perhaps the science and being close to the progress that's being made to focus on other parts of the business just that are required as a public entity. So keep it in mind before you think about taking the plunge. That's all I had prepared. I hope you found at least a few helpful insights and some perspective around the updates on the markets. And I appreciate your attention today. And with that, I'm happy to transition to the Q&A portion of the segment. Thank you.